My first question is a big one. It could take a whole hour, but let's start here. What actions and decisions are you taking today to improve the Disney company's financial performance going forward?
That is a very good question.
Loaded.
Okay, so settle in, everybody. So this is a great question, and I know we just had earnings last week, and I would like to clarify a few things. But, there are things that we are doing as a management team that are very responsive to the current environment that we're all working in, plus facing some of the challenges we have as a company. Now, the things that we have firmly in our control are things like our structure, the way we are structured for managing the company, as well as the cost structure. And as I said in our call, we are well on our way to meeting or exceeding the $2.5 billion of SG&A savings that we put out to the market previously, and feel really, really good about what we've done to date and what will still be achieved in the balance of this fiscal year that you'll really see the benefits in 24. So that's something that I just want to lean into a little bit. And then Bob Iger is really addressing the content spend. He's looking at not only what we're spending, but how we're spending and where we're investing those content dollars. So those are things that are firmly in control of the company. And I think, the benefits of those, the more immediate one will be the SG&A achievements that we deliver. Content spend will be a little bit longer to really see because of the time it takes for projects to go into development, production, post-production, and then go on things. But it's all underway. When we look at our businesses, there's one thing I want to clarify a bit, and that is our subgrowth. So we are looking at our subgrowth, and I want to differentiate because Alexia Quadrani, many of you know Alexia, she's our head of investor relations. But last year we talked about, we were always announcing subgrowth as one number, and we broke out Disney Core Plus. Disney Plus Core subscribers versus Disney Hotstar subscribers. And the reason we did that is because there's very, very different dynamics in terms of ARPU and the potential for revenue generation. So we did that, and I think the headline number, and I know a lot of people in this room, you've looked at the numbers, you've looked at our Q, you've gone through the press release, you've looked at the charts, and you know that when we broke it down like that, you saw that there was a decline of 4.6 million subscribers in India, and collectively, we lost 4 million subscribers globally, which meant that Core Plus, Disney Plus Core subscribers were actually up. They were up less than 1 million. We wish it was a larger number. We hope to have achieved that, but we did a price increase, and you saw some attrition there. Rita will talk about how what the prospects for our ad-supported tier look like going forward. But once again, we just started the ad-supported tier back in December, and she's looking at that and things we can do. And we are also looking at pricing overall and pricing for the ad-free, which is really a premium product, in comparison to the ad-supported product, which is at a much more accessible price for consumers if they choose to, watch ads. And we know from our research that, a lot of people don't mind watching ads. So, it's a consumer proposition that people can avail themselves of. But I just want to focus on that core Disney Plus core subscribers that, we believe that is something that, especially the second half of the year, the latter part of this second half, just based on our really strong content that's coming on the service, both originals as well as some of our theatrical releases, which will then come on Disney Plus in the Pay One window. And so when you look at what our development teams and our content teams have done, led by Dana Walden and Alan Bergman, we've got some really good content that's coming on. And once again, the timing of the content releases, we're still, we've been in this business for 3.5 years. We've got content that's releasing latter in this fiscal year that we really think is going to drive subscriber growth and also be favorable to our churn metrics. So that's on Disney Plus. Also, we're looking at optimizing, as Rita will talk about later, that ad tier. And also, we've talked a lot, and Bob has articulated this, really looking at our pricing structure. And we don't feel that, where we are today, we haven't optimized that pricing algorithm. When you think about the different levers, there are some different markets, but there's also the ad-free and the ad-supported. And looking at the consumer proposition and where you want to lean into the differential there. So I think there's some things we want to refine. When we look at the other elements of the business, linear has gotten a lot of attention. I know that there's focus on subscriber growth. That is or subscriber decline. That is something that's impacting the entire media sector. Advertising is cyclical. And once again, I think everyone's pretty much down on advertising. I mean, every media company had to report results that were lower year over year. But the fact of the matter is advertising will come back. And just like we did things during the pandemic related to some of our businesses, predominantly parks, because those businesses we had to really address some structural things there. On the ad side, Rita and her team and Aaron LaBerge, who runs our technology, that team is looking at, once again, leaning into more refinements on our ad stack technology and data platforms. Rita can really address this in detail, but I think there's going to be some really exciting developments and refinements that when the ad market does become more robust, we are very, very well positioned. And once again, we just had our upfront yesterday. I think the reception from the advertising community was very positive, and I feel really good about where we are in terms of what we can deliver and the platforms that Rita can sell into. I'd also like to address our parks business. Parks, I've said this before, this is a management team that has really delivered strong results. This is a management team that had to deal with businesses that were shut down for the better part of, call it 2 years. Disneyland was closed for over 400 days. The parks in Asia were closed for significant periods of time. We looked at the cost structure of that business, and that cost structure is one that has allowed us to really come back out of the pandemic very, very strongly. We've looked at our offerings. We continue to invest in our parks. We continue to look at the guest experience. We've had very, very strong results, and we continue to look at that as a growth business, and a business in which we will still continue to invest. And where we will be investing is going to be very consistent with what really makes Disney a unique business in this industry, and that is that we have ways that we can use our intellectual property, our franchises, the ones that really resonate with our consumers, and we have more data than we had before we know when something previously, before we were in the direct-to-consumer business, take for instance our theatrical films that we released. We could rely on box office to know whether it did well relative to a comparable film in that genre. Now we have much more rich data because we have box office for those films that do go theatrical, but we also have the consumer data that we get off of primarily Disney Plus on how often are people watching it when they go on. Is this a movie or a franchise that they're going into for the first time that they're on the service? Do they watch it multiple times? And that better informs our creatives and our Imagineers to lean into things that we can really exploit in our theme park business, where if we know something is truly resonating, something that we didn't have this advantage of that direct consumer data would be something like Frozen. So Frozen was a few years ago. It had tremendous box office performance. We knew it resonated. We had incredibly strong consumer products coming out of that franchise as well. And you remember, we were always comping against Frozen for, 3 or 4 years it seemed. But we have Frozen now that's in Paris. It's coming to Paris. There's attractions in our domestic parks, and we also will have more Frozen attractions around the globe. Now we base that on what we had at the time, but now with new franchises and strong IP, we can also incorporate that consumer data to know how deep it is and in what parts of the world it's most significant in.
Okay, let me go to parks. We'll go through some divisions, and I think you found this interesting that investors are worried that the parks business is over-earning, quote over-earning, at this point in time, mostly due to pricing actions. What examples can you offer that park segment is now on structurally stronger footing than maybe previously, and it's just not all about price right now?
Yeah, there's been a lot of attention on our parks, and that concept of over-earning, as a CFO, I've done this for many decades in this industry and others, over-earning is a kind of odd concept, but I get it. I think one of the things I'd like to just point out is that we are in an inflationary environment, and the macroeconomic environment we are in, we're very aware of that. So, as inflation impacts everybody's life, whether you live on a budget or don't, the inflationary impact of day-to-day living is something that we're very much aware of. So when we look at things in our parks, the one that gets the most attention, Michael, is admission price. And when you go back and look at the pricing increases that we have taken in our admission price, on a CAGR basis, they're pretty much around inflation. So if there's a perception that when you look at our per cap growth, which has been extraordinarily strong the last couple of years, when you compare it to the last kind of base year, which we look at as fiscal 19, when we look at that, the per cap growth was great. It still will be growing, but it's going to be at a much smaller percentage because we're comping off of higher numbers. But where we've seen the real contributors to that per cap growth, sure, a little bit of it is in admissions, but it's also in experiential things that people do in our parks, like experiential food. I know that sounds like a kind of weird concept, but if you go to our parks and you go to Galaxy's Edge, there's unique product offerings, for food and beverage, and that'll be Star Wars related, or they may be Avengers related in the Avengers campuses. But they're really things that people want to Instagram and post, and they're very exciting to, it's part of the experience overall. Merchandise is also something that has, I think we've really upped the game, and things like you can buy your T-shirts and your hats and things like that, plush animals, but you can also do things like build lightsabers, and that's part of an experience. It's not cheap. People spend the money, but that's all, whether it's food and beverage, whether it's merchandise, those are things that are consumer choice, as well as availing yourself of, if you want to spend a little bit more, to get more in a given day, so you can use things like Genie Plus. Yes, you pay for it, but some people, they have limited amount of time. They're not going to be back for X amount of months or years, so they want to get as much in as they can. So that's also driving those per caps up. But that's consumer choice. Right. When they're in the gate, they're spending their money as they choose to.
And Genie Plus, one of the questions is utilization of the parks, how it's changed, Genie Plus. So talk a bit about maybe previous times pre-Genie Plus, and how maybe the park capacity utilization has been different.
Yeah. So you really have to look at pre and post-pandemic on this. And once again, when you're really looking at structural changes and how you're looking at the business, when you're running a park, 365 days a year, which is what we do globally around the world, you can't, it's harder to make changes. But when your parks are shut down, so you have to, look at the silver lining of COVID. And for us in the parks business, it was taking the opportunity to look at things like addressing capacity. And because when we got back into allowing people into our theme parks around the world, we couldn't do it, just open the gates. We had to do it with a reservation system because we were limited. So you had 10%, 25%, 50% capacity, depending on what jurisdiction you were in. And that allowed us to develop a reservation system, but it also allowed us to more, I would say, adequately look at load and demand. And it allowed us to balance labor. It allowed us to look at peak periods, and we got a lot more information on what people were doing when they were there. So as we were able to allow more and more of our guests into our parks, that is something that we've been able to cut off those big peaks, the days when it was really crowded, when the parks had to not allow any more guests in. We know we try to balance those periods and spread them around some days of the week and times of the year, and we can do some of those things through promotional pricing and just sort of a packaging. But it's spreading that demand a little bit better and having it be a better guest experience when our guests are in the parks.
Okay, last parks question, I'll get to networks for a sec, is the recovery of international parks and international visitation to Orlando has lagged domestic. Mexico's come back faster. But you started to see some signs of life last quarter. Can you talk a bit about how those factors could be meaningful drivers of future growth for the parks?
Sure. For the last few years, our parks results have largely been driven by strength in domestic parks. It was not our international locations were not contributors for a few reasons. One of which was we have Shanghai, Hong Kong, and also Tokyo, which we have a royalty agreement with Oriental Land Company in Tokyo. Those parks were closed for significant time, much longer than our domestic parks. Paris also had, on and off with COVID, were allowed to, what was going on in Europe with COVID impacted, their recovery. But the recovery that we've now seen, as we're kind of looking in the rearview mirror for COVID, has been very rewarding to see it because consumers had the same pent-up desire to be in our parks as they did domestically. So as we have been able to open the parks and keep them open, we have seen very strong visitation and spending and utilization of our hotels in all of the international parks. Paris, I love to say this because before we restructured Paris several years ago to eliminate the third-party debt and the third-party equity owners, we had a lot of constraints we had to operate under. We took care of that in the mid-2010s. And now we fully own that park, and we're operating it like we do our domestic parks, and that park is doing incredibly well, and it is its 30th anniversary. And it's really wonderful to see the performance here because it is significant in attendance, per caps across the board for merchandise and food and beverage. In the Asia parks, they're doing very, very well. And once again, we can look out at forward bookings, and those are very strong as well. So we feel really good about our international park business being an additional contributor, not just relying on our domestic park performance. The other business that is has rebounded, and I will say, I admit, far better than I thought it would, just because it had been shuttered for so long, is our cruise business. So as you know, Michael, we launched a fifth ship last fall, the Wish, And with that, I think a lot of consumers looked at our cruise business again. Those who could, get a booking on the Wish. Wish has been very significantly high occupancy, since its launch. But all of our other cruise ships have their utilization and their capacity is quite high. And we're looking at that, and it's really, I would use the words snapped back this year. And it's very, very strong, and that's a contributor to our parks business as well.
Okay. So if we're worried about parks over-earning, we're going to switch to linear networks when there's concern about, hey, when is this going to stabilize? So we've been struck by the margin compression in linear networks this year. What factors are driving that weakness, and can you differentiate between maybe the ESPN networks and the non-ESPN networks, right? Because it's just all put in one bundle right now in terms of the reporting bundle.
Yeah, there's a couple things here, and there was one, there's some nuances in our quarterly earnings, but one of the things is some of the timing of sports rights this past quarter. So we had a step up in some sports rights that had to do with, and those of you who are big college football fans know that when our quarter ends at the end of the year, and you probably hear this, and it just flows off when I say it now in earnings calls, but the college football playoff season, sometimes we have more games in December, the December quarter, and other times we have more games in the March quarter that starts in January. And because of the way that we close our quarters, sometimes those aren't on December 31st. It can be before or after, just because of the way we close our books. So this year there was some college football playoff timing that increased expenses, and there's also the new NFL contract that just had some shifts in some expenses. One of the things I would like to note is that Jimmy Pitaro and his team, when they renewed the NFL contract last year, they structured it very well, but we also will not, because of the ending of one contract, we're kind of at a bridge year, so the ending of one contract, going into the new contract, you're not going to see a sharp step up in that. It's going to be more gradual. But you did see some of that, in this first quarter.
This was a weird year because you had 1 year contract that came out on its own.
Yes. Yeah. And so it's what we call a bridge year. And so there is some noise in that. We try to, break it out a little bit, but I just want to, that because sports rights are a significant cost driver, in linear, which sits in ESPN, but I just wanted to call out that. But the other thing in linear is advertising. Advertising, and Rita's going to address it
That's a segue.
As soon as I stop talking. But she's going to address it. But when we look at real strength in advertising, yes, addressable, programmatic, digital is a growth area. But the other area that we are fortunate to have the sports rights we have and to have the brand that we have in ESPN, advertising for live sports is strong. And Rita can address that, fortunately, and I'm from Boston, so I was thrilled to see, the Celtics make it as far as they did, but 7 games. I like 7 games better than 6-game or 5-game series. It's a little nail-biting, but that's okay. So anyway, I just think, these long series are great for us in the short run, but it's really the strength of, these are, series can come and go. It's the strength and the demand for live sports that is something that Rita can really lean into with her sales team.
Okay. Well, thank you, Christine. Rita, segue to you.
Great.
Thanks for being here, taking your Rita Farrow, for those that don't know. You had you up front last night. I'm sorry I missed it. We had a conflict. But can you give us an update, as Christine was just laying it out, of the current landscape and the health of the ad business as you see it right now?
Yeah. Well, Christine touched on it, right? We have leaned into sports and streaming for the last 12 months. It's where you see the marketplace moving. I'm still very bullish on our linear business, by the way. I think when advertisers come to the Walt Disney Company, and especially in a marketplace like this where you have such, dynamic conditions, people are going to do fewer, bigger things with the right partners. And so the Walt Disney Company has the best of broadcast, the best of cable, the best of sports, and the best of streaming, coupled with the best investments around data and technology that really enable advertisers to buy in as close as they want to make sure that they're spending the right money around the right KPIs that they're looking for. And so you're seeing that in the dynamicness of the marketplace right now. It really resonated yesterday when we talked about owning our tech stack and our data stack, because especially on the addressable side of the business, the dollars come in through the channels they want it to. And sometimes that's direct, and sometimes that's through the various DSP relationships that we have. Sometimes it's data enabled. Sometimes it has audience guarantees. A lot of times it has targeting. We also rolled out targeting on Disney Plus recently around audience and geo, and we plan to have full targeting like we do on Hulu. Those investments that have been years in the making really pay off in marketplaces like this. And so as Christine talked about, it is a dynamic marketplace. It will come back, and we've made the investments around the right portfolio of assets to make sure that we can come out the other side better and stronger. Okay,
so to that point, it's your second year with us. When you look back on the past 12 months, what have been your biggest accomplishments? And are there any meaningful changes to either the market structure or how you've gone to market in the past 12 months?
The biggest change I would say is, without a doubt, interoperability. We have made sure that we have leveraged that ID graph with every partner, every vendor, all of the DSP relationships, all the agencies to set themselves up to be able to transact with us and cum reach across linear and addressable with the least amount of frequency possible and the most amount of reach possible. And that has been really, really important in terms of how people consider where they're spending their dollars. Every dollar has to work harder for every marketer. Every CMO is under a tremendous amount of pressure to deliver on the sales results that they have. And it's a quarterly watch, right? So when they're committing these dollars in the upfront, they want to make sure that they can execute on those dollars in the way they need to at the time that those dollars have to go to market. So that's been really important. We haven't really changed.
And that's more flexibility than there's been in the past.
Absolutely.
Right? And
Absolutely.
So visibility is harder.
And it's about owning your own tech and data stack, which not everyone does. And when you don't own that, you don't have the flexibility to react in real time. That's really, really critically important. And it will be a differentiator as we think about the future. But the other thing is we haven't really gone to market differently. We are still going to market as a full Walt Disney company because the same marketers that were coming in through sports are also looking at streaming, are also looking at our linear businesses. And it's really important that we have that flexibility to talk to them on whatever they want in real time because everyone has change in their business. Right. They have cyclical things. They need adjustments. All of that's really important. And we're still hyper-focused on serving the customer. So we talked about a little bit about it last year when I was here. We have a team that focuses on industries, and they're experts on financial services, CPG, pharmaceuticals. We still do that because it's really important that clients understand the capabilities and everything that we're doing in that space. And by the way, there's ad products that go across. So when you think of, financial services and bank and pharmaceutical, for example, a lot of privacy concerns in those categories. We've developed ad products that work for one that you can take into other categories. So it really helps to connect those bridges. And then servicing the agencies in the way they expect to, right? Which is still a very high level, high service every day. Christine talks about the NBA and the excitement of having more games. I love having 7 games. Trust me, my entire team does. But that means we're in the market every single week. Every Monday I call Jimmy, I'm like, we got to move 150 units this week. We got to move 150 because we have more games. And by the way, it happens. And so that's really exciting because you have the relationships to be able to do that. It couldn't happen necessarily everywhere, but it happens here because we're in the market every day.
Okay, something that's funny, on the last quarterly earnings that was kind of lost was we didn't talk a lot about the ad demand, the opening of Disney Plus, and has consumer adoption of the ad tier met expectations, right? So there's so much to talk about. That was a big initiative, but it was lost in the...
Well, we saw tremendous adoption by advertisers in last year's upfront. We're going to see the same in this year. There's more demand than we've been able to take, candidly. Right. But we're seeing growth in that every single day. You're seeing the subscribers coming in. It's a high percentage that are taking the ad tier, which is helpful for us. Supply is growing week over week. And now that we're rolling out targeting, we're going to actually be able to do more with more advertisers in the marketplace. So we're really excited about Disney+.
And on the consumer adoption side, maybe you want to talk about what, has some expectations, maybe the pricing strategies that you're talking about. How does that change the adoption possibly of the ad tier?
Yeah. So I think from a consumer perspective, it's really interesting because the more that we can marry the back-end technology to really take a look at our streaming services across the board, the more we can really do that. Aaron LaBerge has done an extraordinary job of really looking at the product as well. He runs product and ad tech, which is super valuable because then you're looking at how consumers come in, how do you want to serve them, what are the right tools and environments that you can create within the app to actually maximize our opportunity to drive engagement, which is a core driver of the advertising time, and then to really roll out the right types of ad products that are the right for that experience. And it's not exactly the same as we talked about last year than on Hulu, right? The mix of content is different, the type of consumer is different, and so you want to have native experiences on that app that really drive that. And so having that now together in one kind of team has really allowed us to accelerate that.
Okay. And anything you'd share about the types of people who've taken the ad tier versus the ad-free tier? Anything that you've seen notably on demographics or?
I don't know that I've seen anything specific that would really call out anything different.
Okay. We mentioned that you guys have teased on this already, is that the pivot of more and more live sports ratings taking overshare of non-live. Is there demand for that? Is there incremental ad demand? Or is there just a more limited bucket of people who just want to buy sports, right? We've always thought historically, the NFL has a set number of advertisers. But tell me what you're seeing as sports ratings take a bigger part of the impressions in the world.
I think it's both, right? So I do think that there are advertisers, we talk about it all the time, there's clear advertisers who associate themselves with certain leagues, and they, by the way, come in multi-year on those types of relationships. College football is a big driver of that, NFL, NBA, all the big ones. But there are advertisers who are seeing the growth of sports and want to be there. It's interesting when you talk about live. Live was a big part of what we talked about yesterday in our upfront because if you look across our broadcast network today, about 70% of our content is live when you look across all day parts. It's really important. It's a really important driver of audiences coming together, and brands want to be in moments, and live creates moments. It creates moments for integrations of brands. It creates moments for bigger scale of audiences, and so it's a really important strategy for us as well.
Okay. Something we talked about last year, right? As the mix of dollars move more and more to SVOD and DTC, how are buyers viewing the overall inventory, right? Are they looking at that as a reach extension, or is it more, direct response, programmatically bought? So just, this has been a debate we've all had with our clients, really a discussion. What does that open up? Is that just a reach extension, or is that a different type of advertiser who's trying to avoid more targeted, pinpointed advertising?
It's both.
It's both.
It's both. So we have advertisers. We talked about it at our upfront yesterday as well, because when you cume reach, nobody cumes reach faster than the Walt Disney Company, and it's partially to do with the incredible platforms that we have when you think of the scale of sports. And the scale, no one has the reach of ad-supported streaming that the Walt Disney Company has. It's not available in the marketplace today. And so when you look across our platforms, you can cume reach with the least amount of frequency at the best price. No question. And yet, at the same time, what we're seeing in the scatter marketplace, we talk about it a lot as a team, there is no more scatter in streaming. It's really it's moving to a programmatic business, because you buy in real time with the data that we have across the platforms to be able to leverage the outcomes you want, target the audiences you want, and across our entire portfolio of streaming, so that the ESPN Plus, Disney Plus, and Hulu, in addition to our owned and operated TV everywhere else, right, which are a big piece of our business as well.
Right, and then in terms of client mix, the growth of SMBs, we talked about this last year.
Yeah.
So television's always been national, always been Fortune 500. So what's going on in terms of the mix shift of more SMBs?
We're seeing a lot more of that. Obviously, our stations is part of what we do, and so we combined our station business with our Hulu local business a couple of years ago, and it's really proved to be really powerful and valuable in terms of how we talk to advertisers. We also talked last year about rolling out self-service, and so our self-service platform is now moving to be the underpinning of our local business to drive that SMB growth. It's high volume, low deal size business. And so it was really important to create automation so that we can actually talk to and service the scale of advertisers that are looking to be on the platforms. You'll see more of that as we continue to evolve our business, but it's a really core component of what we're doing to grow that.
Something you've mentioned on the stage this year and last year is the investment you've made in capabilities. Mm-hmm. I know it's central to the competitiveness of where you stand. So you spend a lot of time telling people what you've done, what you've invested in, and how long has that taken to get to where you've got at this point?
Years. It's taken, listen, there are so many streaming platforms in the marketplace today, and you and I talked about it last year. When you come into this business, I think people underestimate the investment in technology that is required to service clients the way they expect to be serviced. There are so many technology platforms out there and competitors out there who have their own tech, and those have been able to move and innovate faster because it's in their wheelhouse. They don't have to get in a queue to be able to do that. They can make the changes in real time, and the dynamicness and the velocity of change that is happening in our business, you have to own your own tech. On the data side, we have a data graph today that is 250 million identifiers, represents 112 million households, and I can't even tell you the amount of signals that come from that allow advertisers to really take and hyper-target the segments they want on the platforms they want. And that ID graph has been really an underpinning of all the relationships we have with all the vendors, the agencies. We've set up clean rooms to be able to do privacy compliant, because that's extraordinarily important as well, privacy compliant matches in clean rooms where we can really use that for not only planning, but buying and then measuring the outcomes on the other side.
Okay. And you kind of led to my next question is, we all wonder, what's the impact of new entrants? Okay, some of the names into this industry.
Yeah.
What has that been in terms of the impact on the market of people moving in, either SVOD, new SVOD ad tiers or the AVOD tiers, the fast channels? Has it impacted the marketplace?
Well, listen, I think it takes share of mind and share of conversation. But again, the winners will be the winners who can drive success in user experience, in quality of content, in capabilities and targeting. It's not one thing or the other. You have to have it all. We have best-in-class content. No company rivals us in that. We are making the investments in data and technology we have been for years to drive that, and ultimately having the business partnerships and relationships to create the demand channels of which people want to buy. If they want to buy us direct, great. If they want to buy us through a DSP, we're there too. We're going to service clients the way they want to come into the platform.
So if I offered you a 3-year lease for someone else's ad tech stack, you would not take
No, thank you.
Okay, just checking.
I'm betting on Aaron.
Okay, so that's okay. Back to Christine. Let's turn to direct to consumer, okay? Mm-hmm. I waited this long. How has the company strategy around DTC now changed with Bob Iger back as CEO? And when will we see the benefits of that pivot built into company financial results?
Well, Bob is back. That is great news. Let me just take a step back on, I think it's directly related to direct to consumer, but it's also related to our businesses. Josh D'Amaro runs our DPEP business, which is our global parks, experiences, and products. That's a global business. When you look on what is now Disney Entertainment and ESPN, those businesses, up until this recent restructuring, were not managed on a global basis. There was, what they predominantly looked at was domestic U.S., and we were largely looking at it as an exporter of content. and rights for sports that were primarily domestic. There were some outside of the U.S., but primarily domestic. And the other decisions on content, even in direct-to-consumer, had been made in the regions, as well as sports rights in the regions, with oversight, but not direct responsibility. So now, when you look at what Jimmy Pitaro's doing in sports, he's managing a global business, which means, and once again, not to sound too geeky like a CFO, but when he is looking at where is the best and highest use of the marginal dollar for sports rights, he's looking at it as a total global portfolio, not just domestic, which is going to allow him a bigger pie, but also to look at allocation. And he may look at, is this better as as something in the U.S., something that expands beyond the U.S., or something that is in a region? And I think that is something that is definitely going to impact our sports business to just be much more rational, thinking of it as a global business, because the Walt Disney Company is a global enterprise. Same thing on the entertainment side with Dana Walden and Alan Bergman. They're looking at spending inside of not only their linear or film businesses, but also in direct-to-consumer. Where's the marginal dollar of content investment best spent? And I know there's been some focus, and once again, there's a lot going on when we release earnings. There's a lot of information that goes into the market all at once. But I think I've read some commentary of some concern over us, cutting back on content, and somehow that's going to have a negative impact on our ability to attract or retain new subscribers and existing subscribers. And that's really not the case. It's really spending our content dollars to the highest and best use of where they will attract and retain those subscribers. And I think that's a fundamental shift that, once again, it may be viewed as a nuance, but when you put that, and once again, Bob has really talked about this, the accountability with a leader, we've seen it operate in parks, in DPEP. Look at our parks business, how well it operates as a global business. That ladders up to Josh tomorrow. And now we're looking at it, and we're taking that same really, really successful model, applying it from a global perspective in sports up to Jimmy, and in our entertainment businesses, which includes direct-to-consumer, up to both Alan and Dana Walden. And so I think this is something I just want to emphasize, that companies evolve. You can always best practices is something that's usually talked about in kind of functional areas. You can look at best practices and take it on an enterprise level. And you just have, once again, parks is global business. When we look at investing in new attractions, it's not done park by park by park. It's laddered up. Where is the best use of that marginal dollar? And that's a mind shift that is really embraced by Bob, and it's embraced by the leadership team. And I think that you talk about when you're going to see it. Yeah. Now, does that happen snap overnight? No, but you're going to see, and we're all motivated, we're all driven, we're all driving to the same, goalpost. We're going to get there. And when you have a highly motivated, really incredibly talented management team, we're going to get there. And so that's just, once again, nuance, but I think it really needs to be emphasized, because I don't think people have really focused on that change in the way we're managing the company.
Well, I would add to that, though, too. When you look at that coupled with, we're doing the same around our technology stack. And so when you think of Disney Plus is going to be rolling out in these international marketplaces, we have a head start. We know exactly how that's worked here. It allows us the agility and flexibility to be able to be responsive. The responsive nature in this rapidly dynamic marketplace is really important, and having those expertise structured in that way allows us to move quickly and decisively.
Right. Another thing I'd just like to add on that, Rita now has global responsibility for how we are going to market in advertising. It's not just being done by region. She has oversight for how that's being done. The other thing is our ad tier. We've launched it in the U.S. in December. It's only in the U.S. right now. She is going to be involved in with the technology teams and the direct-to-consumer management teams, launching Disney Plus ad-supported outside the U.S.
So it's funny, we upgraded the stock on that nuanced idea, and one of the questions we always get is, when does the nuance become results financially? And you say it's going to come. You don't want to put a. It's putting the whole puzzle. This is like a big puzzle. This isn't a 300-piece puzzle. This is a 2,500-piece puzzle, right? But we put all the pieces of the puzzle together, Michael, and the things that you will see first that are going to be evident in our results, the fastest is going to be things on the cost side. The plain old blocking and tackling SG&A. We've addressed it on the labor front, on the technology front, dealing with vendors where we're consolidating vendor relationships. Those are the things that we're doing right now. And there's a lot of focus, and kudos to all the people in the company that are doing this, because it is tough work.
It's tough. It's emotionally draining. But that is what you're going to see first. And some of these other things you will see, but it's not going to be. It's going to roll out. I don't want to give a timeline. But once again, I think it's really important to understand. When people are highly motivated, we like to think of ourselves as a company of winners. And yes, we know there are headwinds in this industry, there are challenges, but we look at the hand that we have to play, and it's a great hand. I mean, as Rita said, she doesn't want anyone else's ad stack technology. We don't want anyone else's hand they have to play on the content, IP, franchise side, the technology that we've developed to deliver direct to consumer. We certainly don't want to change our hand with what we have to play, in our parks, experiences, and products group. So we're winners, and we are going to win. Okay,
cool. Another question we get a lot, thank you for that, is long-term margin potential, let's say core Disney Plus, because I don't want to include Hotstar. Mm-hmm. And given that Netflix has broken about 20% margins this year, can you talk a little bit about your give and takes and what you think about long-term margin potential for Disney Plus? I know that's also in a budget change because of pricing.
Yeah, I look at Netflix and I see where they are. We have not put out a margin goal yet because we're still getting to break even, which we have firmly in our sights. We're going to march towards that. But we wouldn't be doing everything we're doing if we did not believe that this was a business that would deliver long-term sustainable returns to shareholders. That's the best way I could answer it, Mike.
Okay. A couple more. You announced on the call combining Hulu with Disney Plus, for existing subscribers of both services, putting a Hulu tile there. What benefits do you see by bundling all the Disney products together? And is that strategy working?
Well, we haven't done it yet.
Right. So. Well, yeah, but let's let me do the Disney bundle first,
yeah,
and then add the Hulu tile. To Disney.
The Disney bundle, there's a two-part bundle and a three-part bundle. One is Disney Plus and Hulu, and then you can also have Disney Plus, Hulu, and ESPN Plus. What we've seen, the characteristic that we've seen in all of those bundle offerings is because it is a great consumer proposition, and it has multiple offerings. It is the characteristic that is most meaningful from a performance perspective is lower churn. And so it means there's more for the consumer, so they stay in it, and it just has lower characteristics. One is the value proposition, and the other is the content offering, how wide it is.
Okay, so in that answer, then talk about what you're trying to achieve by creating a more unified app in terms of Hulu and Disney Plus.
So what Bob talked about on our earnings call last week was putting a Hulu tile on Disney Plus. It's not going to have all of Hulu content on there. It'll have a lot of it. But a consumer who has Disney Plus with that tile when it launches doesn't have to get out of Disney Plus and go into Hulu to find content. It can stay in the Disney Plus platform, go into that tile, which is just like the Marvel tile or the Disney tile or the Pixar tile. You go into that tile and then you can search for the content without having to go in and out. I have a fundamental belief that when you present friction to a consumer, it's never the best experience. And so eliminating this friction, it's just human nature. You're not asking someone to do an additional step. You just stay there. If you want to pop out of whatever you're watching, on one of our other tiles into Hulu, you just don't have that additional steps.
Right. And then Rita, one of the talking points on the strategy change is better for advertising. You'll talk a bit about how does that help you monetize advertising by unifying the tiles.
Well, first of all, it drives engagement, and so engagement is a core component of how we think about ourselves as a streaming platform. It's really important as you think of, again, what Christine talked about, frictionless experience, but the whole consumer journey from the time you step into the app to the environment that you experience within, moving from content to content, the recommendation engine of what comes after you've watched this, what's coming next, and what that advertising experience, that's where we're going to win. Right? That's where understanding all of those data points and signals that we're getting from how users come in and experience that product is really going to drive how we think about the consumer journey, how we think about the advertising experience, and ultimately how we deliver for brands in that experience. And so, it's going to start within that, and hopefully over time, having them all on one back end allows us to have richer data on the consumer, what they like to watch, what they don't like to watch, and better advertising because of that.
Okay. Christine, in fiscal year 2018, Disney generated, by our definition, over $10 billion of free cash flow. Since then, we've had a global pandemic, massive shift to streaming, and the acquisition of Fox. When you look out the next few years, how should investors frame Disney's ability to return to the great cash-generating days of old?
Little did we know how much fun we were going to have over the last few years.
Exactly, yeah.
Yeah, we've had some headwinds that we've had to contend with, whether it, you just iterated all of them. As a CFO, free cash flow is near and dear to my heart. We look at our ability, when you look at the parks business, that generates a lot of free cash flow. You look at things like the resumption of theatrical distribution of feature films. That's also a very strong cash driver. Cash is something that we look at very keenly. Direct-to-consumer was also a new cash flow for us. I mean, we never had that cash flow direct from consumers before, so it was incremental to us. But given the investment phase that we've been in, our cash flow has been muted. But it is something that we look at with a very keen eye towards improving, and we're driving towards it. So our cash flow is up year over year. This is not the end. We are moving forward. We're going to continue to make progress on that. But I'm not going to give an estimate, but we are going to keep free cash flow in mind. And at some point, as you know, we've talked about resuming a dividend in not too distant future. It's not going to be where we left off, but we're going to get back in the game. And that's something I think that is returning capital to shareholders is something that we all also think about in addition to growing our businesses and investing in our businesses.
Right. And then I asked you on the call about trying to frame peak cash content spending at sports. At some point, will you give us a waterfall of like where you see? It feels like this year's peak based on this year's flat versus last year, right?
Yeah, this year's flat versus last year. We said it's around that $30 billion. We have a writer's strike, if anyone hasn't noticed yet. So that may impact cash spend for the balance of this fiscal year. We'll update that, if it's appropriate, when we, speak publicly the next time. But yeah, we'll continue to invest in content, but we're looking at, once again, where the content dollars are best spent to drive the consumer engagement and attraction of subs and retention of subs. Okay.
So in my last couple of minutes, I have a last one for both of you. I'll start with you, Rita. If we have the benefit of coming back next year and doing this again, what do you think will be the biggest surprise what you share on stage with us a year from now?
Wow, that's a good one. The biggest surprise, I think, will be just how the market evolves. I think this notion of where the market is going and how quickly it's evolving, it's hard to even know really like where the biggest opportunities will be, but I fully believe that they're still going to be in the sports and streaming marketplace in the near term. But I think the amount of data that we're getting in and the amount of signals and how we transform our business into a much more automated, data-enabled, programmatic world will be far ahead, where I actually think it is, and I'm pushing it there, but I actually think it's going to actually be the adoption will be far greater.
Which will put pressure on linear-only models that don't have the tools.
No, on the linear side, we actually do data-driven linear, and that's still an evolving business. And because we have this ID graph, we can actually take the learnings and really apply those audience segments on linear. So it actually, having that ID graph for our addressable business has allowed us to really bring the linear businesses along. Okay. But there's no question, the more dynamic, the more capabilities, the more robust that business becomes, you have to be a player there, and you have to really own the graph and own the tech to be able to deliver on it.
Okay. After you, Christine.
Yeah, it's a great question. I don't know. What ad recession were we talking about in 2023? Yeah. It's once again, it's cyclical. It's going to come back. The economy is going to move on. I think we have better days ahead, and we'll be looking at some of the headwinds and challenges, and forgetting that we were worried about it.
Right. Okay. Okay. Very optimistic. Thank you.
I have to be optimistic.
Exactly. Yeah. Thanks for being here. We'll start again in 10 minutes.
Thank you all.
Thank you.